coronavirus has really shaken up the markets. Is it a short-term thing?
I think so. I think what we're going to see is we've obviously seen the negative impact of short-term growth potential, particularly in China, but there's obviously a lot of neighbouring countries where there is going to be a lot of exposure. You've just alluded to the contraction we saw in Japan in Q4. That was largely driven by an increase in the sales tax, but now the country's really at risk of recession because when you compound that with the coronavirus and the impact that that's had on business, then Q1 is also going to be weak and, like I say, the potential for recession. Then it's a case of how countries deal with it, how central banks deal with it. Do we see more interest rate cuts this year? China is quite an unusual country in that the efforts to stimulate the economy are likely to be more extreme. The government is likely to do a lot more on the fiscal front as well as the PBOC on the interest rate front in order to try and stimulate the economy. There may be more headwinds in other economies, though. You look at somewhere like Germany, a lot of restraint on the fiscal side. So we may not see the second half boost in a country like Germany that we will see in China, but I think over the course of the year you'll see a marginal impact, but it will be short-lived.
Let's get back to China for a moment, because many people are making comparisons with the SARS outbreak, but the Chinese economy was a very different animal back in 2003, much more important, a much bigger player now. Well,
it's a much bigger economy in general over the course of the last 17 years. It's grown enormously, so I think it's maybe around twice the size that it was back then, but then it's also hugely more important on the global stage. Again, we look at its role within the modern economy, and it's a hugely important part of the supply chain globally. So what we've seen, for example, in the car manufacturing industry, we look at somewhere like Toyota, where we've had to see production almost cease because they rely on parts in this just-in-time manufacturing process in order to enable business to continue. But there's many other areas as well where it's hugely important. When we look at things like tourism, airlines have suffered, hotel groups have suffered, and then obviously just Chinese consumers as well. We've got to remember, everyone almost sees China as a selling economy. It's also a buying economy, so other exporters around the world also rely on it. And there's many other cases as well where you could look at to say that why it's far more important now than it was in 2003. And we're only going to learn really how big an impact that's therefore going to have over the coming months once we start to see GDP data and other forms of data as well from other countries around the world.
We've been talking about these coronavirus disclaimers from a lot of companies as they're looking ahead, lots of profit warnings. We've had that from some of the airlines. You mentioned tourism, travel's really been hit.
It has, and it's like I say, it's really difficult to quantify this right now. The companies themselves are going to be able to look at the raw figures that they get on a day-to-day basis and try and quantify what kind of a near-term impact that's going to have on their Q1 results, maybe even heading into Q2. But the difficult thing to quantify is just the impact it's going to have on the consumers longer term, and that's something that even companies are going to struggle to deal with. Are people going to be as comfortable travelling, going to built-up areas? You look at things like shopping centres, crowded, congested places. How long is it going to take consumers to start moving back to these places and feel more comfortable? These are the type of things that's really difficult to quantify. So we're going to take a bit longer than the companies themselves to try and quantify, like I say, just what kind of an impact it's going to have to near-term GDP and near-term economic prospects. But really, it's probably going to take most of this year to try and determine just how big a longer-term impact. Like I say, some countries are going to have the benefit of huge fiscal stimulus package, monetary stimulus packages like China, and you think they're going to act quite quickly in order to try and support it. So the second half of the year is probably going to see a lot stronger GDP figures offsetting the year as a whole. Other countries, other economies are probably going to struggle a little bit more because they don't have governments that are quite as willing to pull the trigger.
And we might see companies rewriting their business rules in response to consumer demand and what they want. Look, we talked about travel. You mentioned cars. Of course, we've got JCB here in the UK from today. There's no overtime, they're a shorter working week, all because of parts. A lot of European companies rely very heavily on China. Do you think that investors are punishing them for not having a backup plan?
Well, I think this is just another event that makes people realise just how reliant they are on others in order to get business through, and maybe over-reliance as well. We've seen, for example, over the course of the last 2 years, I think there's probably a lot of countries and a lot of companies who've realised that they are incredibly over-reliant on the US for certain parts of their business, who now realise that they maybe need to diversify where they get their products from because of trade wars, who they sell their products to, because...
So they pivoted east.
So they pivoted east. And now you're probably seeing a situation where there's probably certain companies who are now looking at China and saying, well, actually, we've integrated our supply chain so much, we're actually hugely now dependent on this, and maybe we need to diversify more. But ultimately, I mean, That makes life difficult again because diversification creates extra cost. Part of this kind of integrated global supply chain is so that you can localize, which reduces cost. But now companies may be looking at the way the world has evolved over the last couple of years and saying maybe we need to balance the risks versus the costs here. So again, it is going to be really interesting to see just how companies do perceive these things. Obviously, you can't really just take the coronavirus on its own. The last outbreak was 17 years ago, maybe 50 years until we see something of this kind of level again. So maybe they won't look at this issue in particular. What it does do is it highlights all the vulnerabilities. And
it's interesting how quickly the conversation changes, because normally we were talking about trade wars and those kind of tensions affecting market movements. US election, any kind of general election, and now this has been the talking point that's shaping what people are thinking about. I have to talk to you about commodities.
Absolutely.
Oil making a nice recovery, still not you think there's room for manoeuvre?
There's absolutely room for manoeuvre. I mean, what we've got to look at in these markets is that when something like this happens, and this is so rare, but let's take the situation at the beginning of the year with the US and Iran. These kind of unexpected events that you can't really account for when you're making forecasts or when you're making plans. When these type of things happen, you do see a lot of movement in the share price, and a lot of it initially is driven by fear. What's the worst case scenario that we can feasibly see happening here? You've got to remember, with the coronavirus, this was initially the worst case scenarios. This could be as bad as SARS. Well, actually, it's much worse than that. So you see the initial fear moving many of these markets, and oil, it hit the price of oil extremely hard. Unlike share prices and other things, they can't really be lifted by monetary policy. It can't really be lifted by necessarily just by government spending. So this was almost the most accurate reflection of how investors perceived the coronavirus situation to be. So the sell-off was very extreme, and it's taken a lot longer to recover compared to share prices, which, as you've alluded to, are back at record highs in many cases. But now we're 10% off the lows. We're still 15% off the levels we were pre-coronavirus. That suggests to me that, yes, the near-term effect on the economy has severely impacted the price. But it also suggests to me that somewhere in the middle, maybe even towards the upper end of these two price levels, there is a happy medium where the price will probably be over the next few months. But again, I'm making this assumption. I didn't see the US and Iran story at the start of this year happening a month before it happened. So anything can shake up these prices in the near term,
maybe
in the medium term. Production cuts as well. Russia doesn't necessarily seem to be as on board with that. But they may become on board with it if this does continue and if prices continue to be low. So there's so many unpredictabilities, I guess, in these markets at this moment in time. But I do feel like prices are still a little bit at the low end.
A little bit at the low end.